You've been head of ESG at DB Advisors for several years now. Have you seen interest in sustainable investment peak since the financial crisis?
I think we have seen a growing development, and by all means the financial crisis spurred the interest and demand for ESG. By now you have about 1% of overall assets under managed being invested in ESG considered portfolios and investment. And in the last few years, coming from 2007 to 2009, globally, the invested assets under management grew from 5 trillion to 7 trillion, and the European portion within these 2 years grew even from 50 to 70%. But I think, with all due respect, we can't call it a peak. But I think what we can consider is that most of the investors really changed their mind and adopted ESG as part of their risk management. And in former times, you were talking about value management with the Graham and Dodd approach. And I think as ESG is being more and more considered to be sort of a value layer on top of your strategies and your asset classes, I think perhaps in the medium term, ESG could be even considered as the Graham and Dodd approach of the 21st century.
So what are the most important trends and developments in the German ESG market?
I think integrated reporting really took off in the last few years. A lot of companies are focusing towards international initiatives like the UNPRI. A lot of activities were going on. For example, there was just being delivered a German Sustainability Codex from the German Sustainability Committee towards the German administration last week. And the German Stock Exchange just developed a first global equity ESG index, which is based not on market cap, which is the usual approach for equity indices, but key performance indicators, which really fits more the approach of ESG.
Your own research has shown a relationship between greenhouse gas emissions and financial performance. How do you go about assessing a company's carbon risk?
It's a very interesting point, actually, because even academic studies in the last few years figured that there's a tremendous correlation between environmental risk on the one hand and, for example, corporate bond spread on the other. It really matters when you have environmental risk and you pay attention to it by being very transparent as far as reporting requirements are concerned. And the overall result towards that was that could have an impact on your corporate bond spread by getting diminished up to 65 basis points, which is quite a wake-up call for every CFO on the corporate side. So we address this issue and then talk to a lot of corporate clients that they should adopt these sort of reporting initiatives, because there at the US corporate bond market, you could see that it really matters. And we suppose in the next few years, it will be even more important for the European corporate bond market.
And you have developed a solution to help offset that risk?
Yes, that's right. We developed actually a solution in a 3-step procedure by saying, in the first place, we determine what's the risk all about. So what is your corporate carbon footprint and your financial carbon footprint? Most of the companies, they know their operative carbon footprint because of their production sites and what have you, but they are relatively insecure about what is their financial carbon footprint. And for that purpose, we take their financial portfolios. In the first step, we determine what does the financial carbon footprint look like. In the second step, then, we go for that respective portfolio and optimize it by saying we change, for example, a corporate bond portfolio and reduce, by taking the companies which have a relatively low carbon footprint, reduce the overall portfolio financial carbon footprint by more than 20%. That is this optimizing second step. And in the third step, you can then even offset the remaining financial carbon footprint by buying and installing an overlay, a carbon overlay, which means you're buying derivatives on CO2 certificates. And with this three-step procedure, you really change your financial carbon footprint for all of the investors.
What are the latest product trends in ESG?
If you want to have a look at the latest product trends in ESG, you have to see the different phases of how did products get developed in the past and where are we going from here. So everything started out obviously with large cap equity and correspondingly with corporate bond portfolio. In the second step, then there were sovereign bonds involved, and as more and more ESG indices were developed, passive portfolio came into play. Right now we are at a phase as we have different asset classes that multi-asset and multi-asset strategies are becoming more into favor. And the next few steps will be, first of all, up to now we were just talking about long-only portfolios. In the medium term, we think that a lot of the hedge fund managers, but also conventional manager, will adopt a long-short approach for ESG, because from the results of ESG ratings, you have ratings for good and for bad companies, so you can't just underweight the stocks and the corporates, but also going short. So I think this long-short strategy will be a real important strategy for the future to come. And on the bond side in particular, we think that emerging market is really coming into favor, because right now people are really looking for new sort of asset places and diversify their portfolio, and that's what they are doing with emerging markets. And ultimately, as we have been talking about before, I think overlay management will become more and more popular as soon as more and more derivatives and indices will be introduced also on the ESG turf.
Finally, how important is it to have the DB Advisors global research platform supporting your work?
We consider it to be very important to have an own proprietary database. And in the last few years, we even added our ESG know-how and approach towards this database. So what does that mean in practice? You have every analyst and every portfolio manager around the world who have a look at a stock or at a corporation. He does see the conventional assessment, but also the ESG assessment and the ESG rating. So he can adopt all sorts of valuations, including the ESG. And that's even more important because on our way from a niche towards mainstream, it's very important that you train all your portfolio managers and analysts around the world with this procedure and with the analytic methods. And therefore, we are glad that we have this sort of global system where everybody can have access and also can assess the data and change them. So wherever you are around the world, you can see what the analysts and portfolio managers are changing and can grab any information you need to in order to get a proper portfolio construction going.